Hello! If you're not familiar, my name is Michelle. This is Actuariel, my actuarial YouTube channel, and today I thought I would show you something a little bit different. With the new year comes new tax-free savings contribution room, which means I'm going to be investing $6,000 into my TFSA, my tax-free savings account, and I thought it'd be fun to show you exactly what I invest in, why I invested it. I'll share my screen. We'll look exactly at the mechanism of how I do it if you're new to investing and you have no idea what a person does. Thought that could be fun. If you have other personal finance questions, feel free to leave them in the comments below. Otherwise, let's have some fun spending $6,000. The platform that I personally use to invest is Questrade. I know a lot of people who also really love Wealthsimple. If you live outside of Canada and have an investing platform that you really like, please do leave it in the comments below. I'd love for the comment section to be like a helpful, collaborative place for people to look and learn about different investing things. Obviously my knowledge is more Canadian because I am Canadian. The general principles that I share here will hold true anywhere, but the actual mechanism is Canadian. I pulled my investment strategy from the Canadian Couch Potato website. I was recommended this by a book that I absolutely love. I recommend it all the time, called The Millionaire Teacher. I love that book. But they recommended the Canadian Couch Potato website. Here, what they have is they have some model portfolios. The one that I use, the shares that they recommend, no longer recommended. I don't know why they changed their model portfolio recommendations. I still think that mine are fine. I go with the combination of 3 ETFs that I will show you in a little bit, but they do have new model portfolio recommendations if you want. They talk about sort of things that you should be looking for in your portfolios. If I were to redo it, I would probably go with model portfolio 1A, the Vanguard ETFs, because it's the most similar to what I'm doing right now. So they recommend VAB and VEQT. The general goals that I go for are diversification. I want to be buying something that gives me a small part of a lot of different things. So if one part of the economy is going down, another part is going up. The general couch potato strategy, and I can go way more into detail about this in another video if you guys are curious, is to pick the allocation percentages that you're comfortable with for the various types of investments and then just stick with that. Occasionally you have to rebalance, but it's really honestly that simple. So you can see here that they talk about 80-20 bonds to equities. Over here they're talking about 20-80 bonds to equities. Bonds are safer. Equities are less safe, but you're going to get higher returns from equities. You might also get lower lows from equities. So it's a mix of your risk tolerance and age. The general rule of thumb is that the percentage of bonds in your portfolio should be your age. So because I'm 30, my portfolio should be 30% bonds to be safer. However, I do have a riskier portfolio. You never thought you'd heard me say that, because I do have a defined benefits pension plan with my company, which adds a whole other layer of safety, which allows me to be a little bit riskier in my personal investments. So that's kind of fun. The 3 ETFs that I invest in are ZAG, VCN, and XAW in the percentages 15, 25, and 60%. ZAG is a bond fund, so it is tracking a bond index. This is going to be the safest. It is not going to give me crazy high gains. It's also, in theory, not going to have crazy low losses. And it does give me a dividend. My ZAG ETF gives me about 3% in dividends. So that's money that I am being paid for having this ETF. I think it's generally common knowledge that people make money in the stock market just by buying and selling. If I buy a share for $10 and sell it for $20, then I make $10 in profit. But just by owning shares in a company or by owning ETFs, you can also make money. This bond ETF pays me monthly. Some may pay quarterly or annually or biannually. But this is another way that I make money. Just by having this one, even though it doesn't go up and down, it does make me a little bit of guaranteed money and adds a little bit of stability to my portfolio. VCN tracks the Canadian stock market. I keep this at about 25%. My VCN also pays me a dividend. It has a yield of about 2.28%, so less dividends than my bonds, but it will appreciate in value more in theory because it's stocks instead of bonds, which are a little bit riskier. As an example, I will be getting 24 cents for every share of VCN that I own, and the date that I will get paid is on the 10th. So next week, I'm going to be making a little bit of cash, a little bit of extra money that I can then reinvest in my shares. So that's pretty fun. XAW is an ETF that tracks the stock market excluding Canada. So basically the opposite of VCN. I keep 60% of my shares in this, and this one has a dividend of, see, it's all country world excluding Canada. Canada. So it has a yield of 2.27%. And on the 6th, so in 2 days from when I'm filming this, I will be making 40 cents per share of XAW that I own, which is pretty fun. Like, you get a little infusion of cash every once in a while. Just payments into my account. So the way that I do this is I know that my investment total is $6,000. That is the money that I have. I will go into Questrade. I always trade on my phone. I never trade on the laptop, so I'm trying to get my bearings. ZAG. All right, so right now ZAG is trading at $15.59 a share. Over the last 6 months, I would say this is pretty stable, gone down a little bit, but again, we're keeping this because of the stability. We don't keep bonds because we expect them to go up, and it does pay me money per share. I will put $15.59 into my tracker, and that tells me that I can buy about 57 shares. So let's start with 57 shares of ZAG and see what happens. Limit only filled, yes, next. How many shares would I like to buy? 57 shares, next. At $15.59, sure, next. It costs me 19 cents in fees, which I think is perfectly reasonable, and I will place my order. Next we'll search VCN. VCN right now is trading at $42.95. Over the last 6 months, it seems to have gone up by about $2.16, or about 5%, which is pretty good for 6 months. Not too shabby. $42.95. I can afford 34 shares of this. We'll have a little bit of cash at the end, and then we'll see what we can buy. Place my order. The last one is XAW. So this one has gone up by 6.76% over the last 6 months, $36.17. So I can afford 99 shares of that. Now I want to see how much cash I have left in my TFSA. I have $72 left, so what do I want to buy for $72? With my extra cash, I'm going to buy one more share of XAW, so that is the all worlds excluding Canada, and then the rest of it I'll probably just put in bonds, make it just a little wee bit safer. I think I'm gonna buy 2 more shares of ZAG and call it a day. So 2 more of the bond fund. Place order, and boom, there we go. One big thing to keep in mind, and they mention it on the Couch Potato website, is that a lot of people do base their investments on MERs. Obviously, you should not exclusively base it on MERs, management expense ratios. However, this is a big consideration in investing. And if you are paying something like 1.7%, 2%, 2.25%, currently have some investments where I'm paying 1.7%, and this is a shame. In an upcoming video, I may or may not show you how I transfer that out, because I've been procrastinating for literal years, moving it into a lower fee investment like my ETFs. So according to this website, it says that the MER for XAW is about 0.22%. Okay, let's do a little itty bitty math. Let's say I invest $100,000. Whew, I got that cash money, yo. Oh no, we went in the wrong direction. We got that $100,000 cash money in the bank. And we're investing, let's say, investment, time, and fee. Okay? So, let's say we are investing over 30 years, because I am a long-term investor. I am putting my money in now and I am taking it out at retirement. What I am doing is not for short-term gains, it is for long-term wealth. I would like to be wealthy. I would like to retire with money in my account. Thank you. Okay, so let's say that I have 1.7 in fees, because I do have some accounts in 1.7 in fees, and like, we stupid. We know we're stupid. We understand that we're stupid. I started investing by going to BMO, that is the bank that I go to, and I said, hi, please invest my money. And they said, look, we have these funds, they make this amount of money, and I said, cool, do it. I can make equivalent money on non-managed accounts instead of mutual funds. Investing in ETFs allows me the same diversification, the same dividend gains, lower fees. 1 plus 1.7 to the power of 30 years minus 1 means that I'm paying 66% of my money over 30 years, or I am paying $65,817 in fees on this amount of money. Now let's say we switch that down to the 0.22% that I'm paying. Now I'm only paying $6,000 in fees over 30 years. $65,000 in fees? Oh no, not 22%, 22 is a lot. Okay, let's go 0.22%, $6,000 in fees. That is huge, that is crazy. Now, I was talking to a coworker the other day about her investments. She's younger, I was trying to guide her to the light. Her account, 2.25%. $95,000 in fees over 30 years, that's crazy. That is money, that is the whole of your principal. You're just spitting it away. If we look at the MER on my ZAG, the MER on this account is 0.09, so even less. Paying about $3,000 in fees, or 3%. This is just really something to keep in mind. If you go to your bank and invest with the financial advisors at your bank, they will almost certainly put your money in something where you are paying extortionate fees. It is okay, because investing your money in something with 2% fees is better than not investing your money at all, especially if you're in your 20s. Especially if you're in your 20s, investing is better than not investing. However, once you get a little bit more comfortable, I really recommend switching into something that is lower fee, that is still nice and diversified. It's not that much work. If you have personal finance questions, do leave them below. Otherwise, thank you for spending $6,000 with me. Thank you for spending my lunch hour with me. I love y'all, and thank you for calling. Bye.